Hey there, I'm with Bill Rapp from Nexa Mortgage. Today, we're going to talk about a difference in type of loans that you actually may want to get. And we know everybody's pretty sure about conventional FHA, VA information of that nature, but my man here, Bill, actually does commercial as well. So if you have your own home ownership and one day you look to actually maybe start a business, look at multifamily, you have to look into a commercial loan aspect as opposed to a residential loan aspect. So Bill, the question I have for you, for everybody that's watching, can you let them know what can they expect a difference from a conventional or FHA or VA loan, a regular residential loan, as opposed to a commercial loan? What are the differences in those loans?
All right. Yeah, it's a good question. Um, there are a lot of things will similarly translate with some key differences, I guess, is the general concept. At the end of the day, a loan's a loan. You're going to have a payment and you're going to have a down payment. Think about those two similar concepts. Um, so for down payments, well, let's start with borrowers. Attorneys, doctors, dentists. Think those three groups. Those will qualify for 100% financing on owner occupied SBA purchases. These are your gravy. Um, for SBA, you can go get them an office that they can build up. They can get working capital. They can build their furniture, pretty much everything. Set up an office, get ready to go. Bing, bang, boom. That's the easiest way to find a buyer for you, I think, personally. But essentially, yeah, 100% financing on that. They wouldn't need a down payment is the big point. Other classes, maybe they can fit this one. It's a case-by-case basis, but those three, guaranteed. Otherwise, normal down payment would be 10% for that. If you're looking into a traditional building that could be rental purpose, 20 to 25% is the going rate for that kind of product. Those are down payments. Now, as far as income wise for these, it's evaluated a little bit different as far as DTI for residential. DSCR is commercial. DSCR stands for debt service coverage ratio. And what that means is residential is like money to payments or payments to what you bring in. This is what you bring in to the debt you service. So they're bringing in this much monthly. This is their outflow monthly. So it's just evaluated a little bit differently. It's off of their cash flow.
So
You had the question.
yeah, you said there's a lot of terms that kind of float out there, and you had mentioned the one that I had not heard before, but the ones that kind of pop up after, you hear a lot of people say, or lenders will say to their buyers, DTI, and funny enough, I mean, there's a lot of the buyers who don't understand that terminology. So when you say DTI, what are you referring to as far as DTI?
Good question. Debt to income ratio. So when you're evaluating somebody who's buying a home, you got to figure out if they can afford it, and that's really a good basis of whether that they're going to be able to stick there, for a long term. And that's how much you have going out monthly versus what you're bringing in monthly. And I think that should answer your question.
So if I own a home and I look to do to buy a multifamily or invest in a multifamily,
Okay.
or a place that has to be obviously operated commercially, and I obviously need to get a loan. What do I need to look forward to? Is it a difference if I own my own property residentially? Is there something that does it go against what I own? Does it make it more difficult to actually take out a commercial loan? How would somebody look like that if they own their own residential property and they wanted to invest in something commercially? How does that go as far as them owning residential property, and how does that help or hinder them in buying the commercial?
Good question. So when you're making a leap into the commercial space as a homeowner yourself, it helps to establish that you already are a homeowner at that point in time, and you've proven that you can maintain a home. So yeah, usually you need to be a homeowner before you go into. You can buy as a renter. I have done that before with people. It helps to have a lot of liquidity in the bank accounts if you're going to do it that way. But yeah, you can. Really, in the commercial space, you're evaluating this project as an entity of its own. You're not evaluating you at that time. Although you have to be solvent, you are part of the equation. This is another entity all to itself. So we're looking at this as where the cash flow is coming from, and what does this entity incur its expenses from. And as long as the cash flow is greater than the expenses, that's how we determine the debt service coverage ratio.
That's fantastic information, and I think for a lot of people that actually look to get into investments as they go, and they don't want to just stick directly to residential, they want to kind of peek in and go into something where they can have something commercially. That's outstanding information. I hear a lot of the terminology, cap ratio. Can you explain that to people who are actually looking at as far as a cap rate and what that actually means?
Right. So that is sales price divided by income.
All right, so if I'm looking into, let's say for instance, you hear also two terms, buy hold and buy flip. What are reasonable expectations in the market today for, let's say if I wanted to have something and I bought it to flip, what should I actually look to maybe make a good purchase perspective from a commercial appeal?
Say that one more time. I kind of got lost in the thought.
Let's say for instance, like say if I have a scenario to where I want to buy something, I want to put some work into it, and I want to flip it.
Okay.
So a cap rate conversion that comes back for somebody that's wanting to flip. What is considered peak in the market today, or an idea that's actually profitable for somebody looking to do that?
I try not to get lost in the cap rate. I really
Okay.
just kind of look at the numbers to see if it's going to make sense. Cap rates are really kind of they can mislead you, I think.
Okay.
Yeah.
That's great information. I think a lot of people get so tied into it, and I'm glad you said that. I've had people that I've worked with before that have actually said I have to have anywhere, when I want to flip things, I've got to have anywhere between 12 and 20%. I've had people that want to, when they buy hold, they have to be at 5 or 6% or above, and sometimes obviously those numbers aren't quite there.
Yeah.
And I think that can be a little bit dismissive on where they are realistically.
I think
that's good advice.
I think a cash on cash rate is the more effective measure of what you're going to return. So that's a better number to look at.
That's a great idea.
Yeah.
So, well, hey, for more information regarding looking into diving into commercial real estate, go to my website, htxhomesales.com. Go to my preferred vendors. You'll see Bill's information on the mortgage lenders there. Hit the button for his website. Go for more information. Or if you want to contact directly, you can reach out to me by subscribing to my page, and I'll actually put you in touch. And hey, thank you so much for watching this video. We hope it was informative for you, and we look forward to hearing from you soon. Have a great day.